Good morning and welcome to this Monday, February 8th, 2021 edition of Trading Places Live here at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it looks like the market is looks to get off to a pretty good start this morning. Dow Jones futures currently up 140. S&P 500 up 15 and a quarter, and NASDAQ up 59. So a slight edge there to the Dow on a percentage basis. But clearly, it looks like some of the strength that we saw last week is ready to carry over into a new week. Looking at some of the commodity prices this morning, gold up about 1%, silver up 1.6%, copper up 0.3%. Crude oil is up 1.2%. $57 a barrel now, up over $57 a barrel on crude oil. We've got yields up. So yields up slightly. We're up a little bit more this morning, but yields moving higher. Of course, that means bonds are moving lower. We're going to talk about that some in just a bit. Across the globe, we got Asian markets up higher. We've got European markets up higher. Of course, the one I like to watch closely, the German DAX up about 0.5% today. And the reason I say that I look closely at the German DAX is that is the index that seems to have the most positive correlation to the S&P 500. So I always look for clues about the day's trading action, what's going on over in Europe, especially in Germany. That's looking pretty good. And of course, as I mentioned, futures up across the board. So looks like we're going to get off to a pretty good start, which is always a positive on a Monday. If you're not familiar with one of the really strange historical trends of the stock market, since 1950, Mondays on the S&P 500, we've had annualized returns of minus 15% on Mondays. And it's easy just to shrug it off and say, well, it's just one day. Well, it's one day every week for 71 years. That's a lot of trading days. But Mondays tend to not be that great, especially later in the month. As you get past, right around the options expiration, that Monday after options expiration, you always want to be careful then. But usually there's a couple Mondays later in the month that don't go so well. So you always want to pay attention. But today anyway, no Monday blues. We're off to a pretty good start, looks like, or, get off onto a good start. We'll see what happens after the open. But at least for now, things are looking pretty good. All right, let me move you over to Earnings Beats. If you're unfamiliar with Earnings Beats, welcome. And I would love to have you join our community. We've got a free Earnings Beats Digest newsletter. I publish this Mondays, Wednesdays, and Fridays. Normally talking about relative strength, earnings, individual stocks, sometimes industry groups that are starting to show strength and so forth. But some pretty good trading ideas come out of this from time to time, and also a lot of education. So if you're not already a subscriber, I'd love to have you. All it takes is your name and email address. No credit card. Not interested in that. You can unsubscribe at any time. Love to have you be part of our community. I'm really proud of the community, a growing community that we have seen over the past, especially over the last year through the pandemic. Hopefully you'll take us up on that free offer and join the community. As far as the paid community goes, you can see over here our portfolio performance. And these portfolios are announced every 90 days, and we're only 2 weeks away from the next announcement. But you can see performance has been absolutely stunning, outstanding, not just this quarter, but since inception. Model portfolio, this is kind of our flagship. We started this back in, I guess it was November 19th, 2018. And since that time, this portfolio is up 245%. We're talking about 2 years and 2 months, 245%. The S&P 500 has done well. What's amazing when you think about the S&P being up 44% since that time, that's a good return during any time. But we've been through the trade war and a 100-year pandemic, and folks don't believe the market's going to go higher. I don't really get it. I mean, we couldn't have had anything worse thrown at this market. Well, maybe we could. Maybe I shouldn't say that, but we've had some pretty rough stuff thrown at the market the past couple of years, and the S&P is just shaking it off. This is what the market does during secular bull market advances. Sure, we get fearful and market gets volatile and we go down for a period of time. But in a secular bear market, that goes on and on for a long time. In a secular bull market, it's literally like dusting or, flicking the dust off your sleeve or something. It's like, all right, we're done with that. Back up, to the upside. And folks can't understand it. They don't understand it. The problem is, and why most can't understand it, is first of all, the valuations. Where are you going to put your money if you don't put it in the stock market to earn a return? Think about it for a second. Bond market, going to put your money into a 10-year Treasury yield, get that 1.17% or whatever it is right now. When interest rates are this low and earnings are growing like they are, and earnings, I've never seen earnings growing as fast as they're growing right now. Fed's already come out and said, we could have 5% GDP growth. I think when it's all said and done, I think we're going to have 6% or more GDP this year. I think there's so much pent up demand. I think as summertime rolls around and these virus numbers start to decline, I think we're going to see a huge a global economic rally just because of all the pent up demand. And that is going to send earnings soaring. Feds said they're going to keep interest rates low. All of that combines for nirvana in the stock market. But I'll show you one other thing in just a minute that's going to drive the stock market higher. But we'll get into that in a minute. Let me go through what happened on Friday. Dow Jones Industrial Average up 92, S&P up 15, NASDAQ another good day up 78.5, closing at an all-time high 13,856. I know just a little over a week ago we were making these breakdowns below the 20-day, and Dow even went down a little bit below the 50-day. But that's in our rearview mirror just that quickly. 5-6 trading days later, we're back at all-time highs across the board. Mid caps finished up 1%, beating the other three major indices. But small caps actually beat mid caps up more than 1%, 1.17% on Friday. So across the board, we saw more solid action. Look at these AD lines all turning back up to the upside with that strength last week. That's all good news. Materials led the market on Friday up 1.7%. Communication services also moving up, breaking out along with discretionary stocks. The interesting part about discretionary, and I had to listen to this for a while. Everyone said, well, it's Amazon. Well, not everyone said, but I had a lot of folks saying, well, you can't really pay attention to discretionary when it goes up because it's Amazon. Amazon's such a large percentage of the XLY, which is true. I mean, it is 24% or whatever the heck it is. I haven't looked lately. So you do have a lot of influence by Amazon, but this move up and this breakout is coming without Amazon breaking out. So take 23 or 24% or whatever Amazon is, take it out of the XLY and look at what's going on. We're breaking out. I mean, I don't care if Amazon's leading it or not leading it. I mean, if Amazon's leading it, we're talking about a $1 trillion company that is, one of the arguments, I'm kind of jumping all over the place here, but one of the arguments that I hear sometimes is you need to use the equal weighted discretionary ETF. Don't use the XLY because it's so heavily weighted by Amazon. And so I just kind of look at that and I'm thinking, okay, so I should treat a $100 million consumer discretionary company the same as I treat Amazon, which is a $1 trillion consumer discretionary company. I should put the same weight in those two stocks and act like that means something. I definitely want to see Amazon doing well because Amazon, look at all the jobs they create, everything else. I mean, I want Amazon to be doing well. I don't want to ignore the fact that this is a big company because it's a big company. I think it's a driver, not only of the market, but just our economy in general. I mean, why do you want to ignore the stocks that are the biggest companies? I don't really get the whole equal weighted thing. But that's just me. I don't pay much attention to equal weighted. Also having a big day on Friday were the insurance brokers making this big move. I'll come back to this chart. Let me show you this on a daily basis. Look at all these tops up here, just around 435. Closed at 439, volume picked up. That was a really nice move. If I go back to this page, the reason Aon Corp, Aon is on our February seasonality list, our 20 stocks that show tremendous seasonality, good strength during the month of February. So if I pull up Aon, and let's go to the seasonality chart. Now, I do think it was ranked like 19th out of 20, so it wasn't one of the strongest. But, I mean, look at the February, 5.4% annual or average return during the month of February over the last 20 years. 16 out of 20 years, 80% of February is going higher. So seasonality could be playing a role in Aon breaking out. But that was a huge move right there, and that's your reason that the insurance brokers had such a big day. Volume picked up, huge breakout above that area of resistance. All right, I think that was all for the update. Let's move on. I want to talk a little bit about the 10-year Treasury yield and its impact or its relationship with the S&P 500. I do this from time to time, and I'm sure many of our Earnings Beats members, this will be a little bit of a refresher. But if you're not familiar, it's something I think can really help you in the market as we go forward. First of all, looking at the 10-year Treasury yield today, let's get a quick update. We're at 1.18%. We're clearing that high that we saw back in the second week of January. That's kind of a big deal. I thought maybe we'd consolidate longer. We did go back and test that psychological level and the support level right at 1%. That held. We came right back up and now moving through, which should help both financials and industrials. I know industrials kind of went through a little rough patch recently, but this should help industrials coming back, but especially it'll help financials because many of the areas within the financials, especially banks and life insurance companies, they tend to perform based on the direction of yields. So when yields are rising, normally you're going to see financials, those areas of financials, banks, life insurance, investment services, asset managers, those areas tend to perform really well. So that's good news. Now, thinking about this, though, and I'm going to take it one step further because I want to talk a little bit about what this means. Back in the fall, I was bullish for the most part throughout the entire pandemic. I mean, initially, obviously, when the VIX started soaring and prices were collapsing, you've got to be careful and cautious during that period. But once the floor was kind of put in, and I think I even wrote articles just before the floor went in saying we were in a secular bull market, which I guess created a little bit of, well, I received a few emails, let me just say that, about my call that we were in a secular bull market in the midst of a big collapse. But I believe the big picture was higher. And I think history has proven me to be correct, that the market is just shrugging these things off, even big things. And I think a lot of it has to do with rotation from asset groups. These are more cyclical. These don't, I mean, they happen every day, but big picture, it can make a huge difference when, the supply has been exhausted in the stock market, and then you start seeing demand for stocks pick up, and there's no more supply or there's little supply. You go into a period, a long-term period of rising prices, and that's what I think we're in now. So here's the S&P 500. Here's trade war stuff back in 18, 19, some of these little dips. There's your pandemic, and here we are sitting at all-time high. And it just looks like it was a blip on the radar. Well, it was recent enough that we all know that wasn't just a blip on the radar. It was a lot of fear. Some of it, I'll say, in my opinion, was triggered way too much by the media. But it is what it is. I mean, we had and we're still in the midst of a healthcare crisis. This isn't, I'm not trying to, say that the healthcare crisis isn't real. What I am saying is that not all crises outside of the financial markets need to be financial crisis. And I think this was a pretty good example. We had a great economy going into it. Yes, that was a hiccup, but we've come right back out. Once you get past the healthcare crisis, you still have a really good environment, very good economy. And I think it's just, we're resuming. And if anything, we're accelerating now because, like I said, we've got pent up demand. And I think that's going to unleash later in 2021. But let's look at this chart for a minute. So this is a 20-year weekly chart of the S&P 500. The top is just the weekly PPO, but here's the action on the S&P. And then down here is the weekly action on the 10-year Treasury yield. And then down here is a correlation between the S&P 500 and the 10-year Treasury yield. Now, what you have to understand is that during secular bear markets, and I think when you look at this chart, you see how we went down, went back up, went back down, and then finally broke out over here in 2013 above these prior highs. This period, and I don't go all the way, maybe I need to just stretch this out. Well, I got to go 25. The period when we topped here, and then had these bottoms, this whole period, we went from 2000 to 2013, 13 years without the S&P 500 breaking to an all-time high. That is what you get during secular bear markets. 13 years. Now, we had a couple of nasty recessions, one especially this financial recession. This was a near disaster, a near financial system collapse. But it was because of excesses. It was the dot-com bubble. It was the real estate bubble. It was, so you go through these periods where asset prices, the stock market is impacted by things that are happening outside the stock market. Well, I mean, technically, I guess some of it is inside the stock market. Obviously, the dot-com bubble was inside. But it's just the money, you know, when you have a financial crisis, well, folks have to sell their stocks, you know, to cover real estate losses and things like that. There's just things that take place that drive stock prices over long periods of time. And I think we lose focus of this when we go through a short-term crisis. This was a long-term secular bear market. We are now in a long-term secular bull market where it doesn't matter what happens, the market wants to go higher. And there's a couple of different ways you can look at this. If I put this up on a monthly chart, the first thing I want you to look is at the PPO. Monthly PPO is negative during this secular bear market. The monthly PPO is negative during this secular bear market. But during every one of these other, what we consider to be awful bear markets, the monthly PPO doesn't even come close to the zero line. The monthly momentum remains to the upside. And right now we're sitting at about the highest level we've seen throughout this bull market. But that level isn't as high as it can get. As we saw in the late 1990s, we got up to 12 or 13. Many times we got up to, you know, above 5, between 5 and 10. So this isn't unusual where we are right now. But as I look at this, so the first thing to think of when you've got a secular bear market, when you've got a big time bear market, monthly PPOs are going to go negative. They're just going to. And I could, you know, send this chart back another, let's go 75 years. I mean, 1982, we took like a little bit of a move down after the bull market had started, barely. But the rest of the 20-year secular bull market, monthly PPOs were above zero. We had dips. 1987 crash, there it is. PPO came down to about 2 or 3. You know, we had some other, you know, there's Gulf War down to about 2. You know, things happen. 94, 95. I mean, that was a slow period, I think, for technology stocks. We got down to about 2. Then we took back off again. But look at the secular bear markets here, 1970s. You know, back in the 50s and 60s, we went back to the center line multiple times. You see the difference? These secular bear markets go a long time. Right now, our monthly PPO is pointing up. We do not want to be concerned or shouldn't be growing overly bearish during these periods. You should be thinking these are opportunities when we run into situations like this. Anyhow, and hopefully they won't happen very often. And normally they don't. During a secular bull market advance, it's not like you go through a rough period every year. We have the last couple of years, but that, like I said, it's kind of unusual. 100-year pandemic doesn't happen very often just by the name. All right, so let's look at the S&P 500 starting in this secular bear market in 2000. When the 10-year Treasury yield goes down, that means money is going into treasuries. When money is going into treasuries and you're in a secular bear market, the stock market gets killed. When you take drops down, because the money that's going into treasuries is coming out of the stock market. Folks are bailing, getting out of riskier assets and into safer assets. That's what's going on here. So there's the big drop. Here's a big drop. And then as we rose here, you can see the 10-year Treasury yield going up. And then when we had the big drop, we also had the big drop in Treasury yields. Now we start moving back to the upside. Now what happens is when we get a move to the upside in yields, the S&P 500 soars. And when we go through a period of downtrending Treasury yields, we just kind of go sideways. We don't get hit hard. I mean, occasionally we get a little bit of movement to the downside, but we rally back. And sometimes you can see here during this 2-year period, rates were going down and we just kept going up. Why? Because so much money was coming into the stock market that you had money going into the bond market and the stock market. There was just a lot of money coming into U.S. markets. And then you go through the period here, 2018 to 2020, see the yield dropping. And we had some rough patches in here. You know, folks were being very defensive. And so that resulted in some pretty big declines. But overall, we just, for the most part, went sideways. So do you see the difference between the downtrend here in the yield and the downtrend here in the yield and the correlation to the stock market? It doesn't, you know, we'll still go down from time to time, but we're not going to just get buried like we did during the secular bear markets. Now, when you look at correlation between the two, and this is just looking over a 20 period. So when you do a PPO, or excuse me, correlation, when you do the correlation, it's the S&P versus the TNX, the 10-year Treasury yield. Put this in here. And then the parameter is 20. That means over the last 20 periods. It's a weekly chart. So it's looking at the correlation over the last 20 weeks. And that's where we stand right now. So you can see the 10-year Treasury yield going up, and there goes the S&P 500. And in 2016, 2017, the last time we had a big move up in the Treasury yields, we had a huge move up in the stock market. Well, in 2013, big advance here, big year in the stock market. End of 2010 into early 2011, big move there, huge move in the stock market. Same thing, 2009 coming off the bottom. So from that bottom through now, when the yield is moving up, you want to be in equities because the yield, it moves opposite the Treasury prices. So if the yield's moving up, it means your Treasury prices are moving down. Folks are bailing out of the bond market. I talked about this last year. And when folks said, well, how can the stock market go up any higher? How can it go up any higher? I said a couple of things. Number one, watch the 10-year Treasury yield. Because when the Treasury yield, which I think if there was any bubble anywhere, it was in the bond market. I'm still not convinced. I mean, you had negative interest rates around the globe. Folks were not expecting, they were actually paying to have the treasuries keep their money. I mean, it was crazy. It was kind of like when oil prices went below zero and they would pay you to take the oil and store it. Rather, you didn't have to pay for oil. I don't know, kind of crazy when you get to that point. But I don't think the 10-year Treasury yield is going to go shooting higher, but I think it's going to work its way higher over the next few years. And as we go higher, the stock market is going to go up with it because money is rotating. I'm talking billions and billions and billions of dollars will be rotating out of treasuries. And where is that money going to go? In a low interest rate environment with GDP this year, 5, 6, maybe higher, percent. And I believe we're going to be in a strong economy for a good long period of time. And so higher growth and historically low interest rates send valuations through the roof. And when valuation, I think that's what's going on now. You got folks look in the bond market saying, I need to be in the stock market. And so they're selling bonds to jump into stocks. That is why we're seeing this. And this is why I believe we're going to see it for the next decade with these scary pullbacks along the way from time to time. I can't tell you when they're going to happen. Sometimes we'll get some warning signs. Sometimes, how are you going to know a 100-year pandemic's coming? I don't think they issue any warnings for that. I mean, we knew in January a little bit about what was going on in China, but the question was, is it going to spread? What kind of flu is it? We just didn't know enough about it. And as things started to unfold, then obviously, we had the big hit. Anyway, I think this is one of the biggest relationships, intermarket relationships, you want to be aware of. It's just rotating money. Has nothing to do with PE ratios or stock market valuations or anything like that. I mean, when the market was selling off, when we were at 667 or 666, whatever the low was back in 2009, people that were selling then weren't looking back and saying, oh, the market was 9 years ago, the market was over 1,500. Now it's 600. It's a really good value. They were scared out of their minds. A financial crisis, we're looking at a potential financial collapse. That's just the way our emotions get. Well, as we keep going higher, we're going to get less and less pessimistic. Right now, the VIX up around 20 or whatever. That's not going to last. We're going to probably head back down to 9 or 10 like we always do during secular bull market. So I would be expecting that. But the beauty is that there's still so much fear in the market. I love it. I love that people don't believe. I mean, I love it when I read articles and say that we're crazy overvalued and the market can't possibly go higher from here. We've gone up so much that I think that's fuel for this rally to continue. Anyway, spend a lot of time on that. We're getting close to our next portfolio selections. Again, if you're unfamiliar with that, go back to our homepage and look at our portfolio performance. Every quarter, we select 10 equal weighted stocks to go in each of these 4 portfolios. They're from different industry groups, not necessarily different sectors. In fact, I want to be in certain sectors. I want to kind of overweight technology and consumer discretionary and communication services and financials and industrials when they start, and they're beginning to show more strength. I want to be in those groups because I believe we're in a secular bull market. And in a secular bull market, those are the groups that lead. If you're in a secular bull market and you're throwing your money into the spider, you've got to realize that you're putting money into consumer staples, you're putting money into healthcare, you're putting money into real estate, energy, materials, utilities. These are the groups that lag normally. Now, energy materials, they're wild card. They're based on what's going on with the dollar. The dollar has a big impact there. But I think the dollar is going to go higher, which I believe keeps a lid on materials and energy on a relative basis going forward. So I really want to concentrate in those 5 areas of the market that do well during secular bull market advances. And I want to find the best companies in those 5 areas. That's how, some folks look at this and they write to me and they're like, well, I just don't want to take all that risk you're taking. I can't say that these aren't taking risk, because they are. But the way you evaluate risk, if you talk to a portfolio manager or whatever, it's, the Sharpe ratio is used to evaluate risk. And it's not necessarily designed to tell you how much risk you're taking. It's designed to tell you if it's worth taking that risk. And if you get a Sharpe ratio of 1, it's kind of, so-so. You get a Sharpe ratio of 2, that's pretty good. You get a Sharpe ratio of 3, that is like off the charts to the upside. Our Sharpe charts, or our Sharpe ratios, are 9, almost 10 on our portfolios. So the volatility that we experience is not that great for the return that we're generating. I know you look at the returns and say, well, you must be putting your money into penny stocks. That's not what we're doing. I mean, if you look at our model portfolio, you look at, companies like Tesla, Advanced Micro Devices, Align Technology. I mean, these are leaders in their various industry groups. These aren't small companies. But those companies tend to outperform, especially when they begin to show leadership. Wall Street's accumulating. You want to be in the stocks that Wall Street's accumulating, and relative strength helps us there. So anyway, as we get ready for this next draft in a couple of weeks, this is kind of how I start my process. I look at the various sectors and see what is leading. I show all of the sectors relative to the S&P 500. And when they're rising, when their relative strength is rising, that's telling us that these are the areas we want to be in. If you want to outperform the S&P 500, you need to invest in areas that are outperforming the S&P 500. I mean, if you've been investing in energy for the last several years, and you're wondering why are my investments not doing well? Well, you're trying to climb a massive wall without any rope, without anything. I mean, energy has been awful. Now, last few months, yes, it's rebounded. Do I think that's going to continue? Do I think energy is going to be the major leader going forward? Personally, I do not. I don't know if we roll back over. Maybe we go flat for a while. Who knows? Maybe we'll continue to lead. But this is something that goes back since 2011, since the dollar has started uptrending. Energy has struggled. Now, over the last year, the dollar's come back a lot, and that has helped energy do basically nothing on a relative basis. If you haven't looked at the dollar, it has fallen more than 10%, which is a huge move in the dollar index. And yet, with all that selling in the dollar, energy hasn't been able to do anything. I believe the dollar goes back up. So therefore, I would expect energy to come down. So I would say that there at this point is probably, I'm not going to say anything is 100% certain, but I'm going to say about 99.999% chance you're not going to see an energy stock in our portfolios. That's not where I want to concentrate. How about consumer staples? Consumer stocks doing well, right? Not consumer staple stocks. Consumer discretionary stocks are off the charts doing well. Look at the different consumer stocks. Which do you want to be in? The ones that are crushing the S&P 500 or the ones that are being crushed by the S&P 500? If we were, into all of these consumer staples names, our portfolios would be getting hammered to the downside. We're beating the S&P because we're looking and following relative strength. And we change out every 90 days. So if something happens and all of a sudden we get a stock or we get an industry group that starts to lag, yeah, we're going to have an underperforming stock or two. But since we started doing these portfolios, when you get 10 leaders and 10 leading industry groups, the chances of all 10 of those companies turning around and going to the downside, I think, are pretty remote. I'm not saying, and I'm talking on a relative basis. There's nothing saying the market couldn't go down. When the market takes a hit, our portfolios take a hit. There's no doubt. You're not going to avoid that. The only way you're going to avoid that is keep your money under your mattress. I mean, if you're going to invest in the stock market, you've got to take the risk of the market going down. But what we have found with these leaders is that when the market rallies back, we do really well with these leaders. The leaders bounce back first, and that's really important. So as I go through, I'm going to be looking at the various sectors. I'm also going to be looking at the various industry groups. So, here's one of the technology groups, computer services. Now, the entire group is not doing very well, but there are individual stocks within this group that are doing well. And so I'm not going to rule out this group because any stock in technology is going to get my interest, especially if it's a major leader versus its peers and versus the S&P 500. Now, if it's beating this, but not beating it that much, and it's still losing ground to the S&P 500, I'm not going to be interested. But if I've got a really big leader, even in a group that's downtrending like this, I'll still be interested for the portfolio. But what I would prefer is something like semiconductors. You will probably almost definitely see a semiconductor in all four portfolios. I mean, that's what we've been doing. We've been putting semiconductors in our portfolios, and look at what's been going on. Again, this is one of the reasons why we're outperforming. We're finding leading stocks in groups that are crushing the S&P 500. You go into software, and the software started to move back up again, which I love. I wrote an article, I think it was in my Trading Places blog on Saturday. But in the last 4 years, this trip right here below this 20-week relative EMA, so this is a relative moving average, we went below it starting in November. We went below it right here. Those were the only 2 times in the last 4 years that we've seen software relative to the S&P 500 drop below the 20-week moving average. This was the only time we've seen it go below the 50. And then we came soaring back the last few weeks with these earnings reports coming out, because software stocks can absolutely blow away estimates. They can rapidly accelerate their earnings. And so the market is looking at that and saying, wow, valuations for these companies should be a lot higher. And so if we get continuing move on software and we can get this breakout, we definitely want to be in software stocks. We'll be looking for some of the leaders in software for sure. Let's look at one more. So let's look at consumer discretionary. So let's look at a group like gambling stocks. Now, this is an interesting group. First of all, they were hammered back at the beginning of the year, starting in January. Once the virus news came out, even in China, gambling stocks really started to take a hit. But when the stock market fell here in the U.S., that's when we really saw this huge tumble. Now, on a relative basis, we are still way below where we were in January. So is the group, strengthening? Yes, it is strengthening. And I don't believe we're going to go back down to these lows. I don't know that this is a group that I would trust for 3 months. I mean, you can see the huge move back to June, and then over the next 2 months, look at the relative weakness. That would have been painful. Then you get a bounce, another big drop. Then you get a big move up, and here we are moving up. I would just be afraid that we're going to see, some of these others. I think overall we're going to trend higher, but I just don't know that we're going to see a straight up move like we see on semiconductors and what we saw in software. I mean, those are the types of areas where I really want to, stick with those kinds of groups. But an area like footwear, this has been pretty steady. I like footwear. So this would be an area within consumer discretionary that if I find a stock that I really like, that's beaten top and bottom line in their last quarterly earnings reports, they beat revenues, they beat earnings per share, and they're in our strong earnings chart list. And, they look really good relative to their peers and to the S&P. They may find their way in if they're a footwear stock because I really like what's going on in this chart. So that's kind of the big picture. Now, if you want to, be a part of that, again, you can go over to Earnings Beats. Make sure you sign up. It's a 30-day no-cost trial. You pay $7 up front. We refund the $7 to you within a week. So essentially 30 days, no cost whatsoever. And you can check the service out. And that will get you access to the February. Usually it's on the 19th when we do the selection, but this year, the 19th, February 19th is on a Friday. So we're going to do it on Monday or Sunday evening, the 21st. But this would get you a ticket in at no cost. So think about coming in, checking out that. That's by far the most popular event that we do every quarter. All right, last thing, let's just do quick 3 you must see. I know I'm running a little bit over here. Let's start off with ZIXI. I'm going to go through 3 breakouts that occurred on Friday, but this one after the move up, sideways consolidation, breaking out, nice AD line, relative strength moving to about 7-8 month high versus software. Just talked about software. This is a stock just making a breakout. I'll get an update and see what it's doing today. It's continuing to go up a little bit, up about 2.7%. So ZIXI looking pretty good. Another one that broke out on Friday, ATVI, Activision Blizzard. So look at that volume coming in, the heaviest volume we've seen probably since May, and broke out with it. AD line's pretty strong. And now relative to its internet peers, it's trying to make a breakout. Now, this one hasn't broken out yet. So if it doesn't continue over the next couple of weeks, I'll probably be able to find better internet stocks. I probably will find them anyway. There's some internet stocks I really like. But that's the second one. And then finally, the last one I have for you is CDW. This is CDW Corp. And breaking out, here was the move up, sideways consolidation. And there's another breakout, volume starting to pick up a little bit. On a relative basis, still got a little bit of work to do to break out above its peers and above. And this is the computer services group, that DV that I looked at earlier. Remember, that's doing so poorly relative to the S&P. Well, this stock has started to show some strength relative to its peers, but it still hasn't broken out. So because it's in a weak group, I need to see a much more strength than that. So I like the stock. I like the breakout, but it's doubtful that you would see this stock in one of the portfolios. I mean, think about the All-Star game in baseball. You know, in baseball, you got all these wonderful pros. They've all got tremendous talent. And, you know, you pick any one of them out and go out and throw some ball with them, and you'd say, wow, they're really good. They're unbelievably good. They're so talented. But you have the All-Star game where only the best of the best get to go. And that's the way I view these portfolio stocks. I don't, you know, yeah, stock might be breaking out and it may look really good technically and everything lines up, but there are just other stocks that look better. Those are the all-stars that you want to have in your portfolio. All right, quick update on the market. See what we're doing, and then we'll wrap this thing up. Dow up about a little over 0.5%. S&P a little less. NASDAQ a little less. But overall, you can see green everywhere. I like that. Small caps leading again today, up 1%. That'll probably help our model ETF portfolio. We did lean a little bit more towards small caps for this quarter. And by the way, that's not on our site here yet, but we're putting something together to get that up because I think it's really important. Our model ETF portfolio in a little over 3 months, almost 4 months now, it's up 21% versus the S&P 13%. A model ETF portfolio. Those are just, right now we have 7 ETFs in there. This quarter so far, we've doubled the S&P 500. When I say this quarter, it's since our last selection date, which was January 19th. So just under a month, three weeks or whatever, we're already doubling the S&P. So, we'll put this up here, but you can check that out during your trial period as well. Check out our model ETF portfolio. Anyhow, that is it for today. So I do want to thank everybody for tuning in. I'll be back tomorrow for Trading Places Live over at Stock Charts TV, starting at 9 a.m. Eastern. So I hope you can make it. I'll see you over there. Have a great day, everyone. Happy trading.